over then. Later tonight, America's central bank will announce whether it has taken the plunge and raised the interest rates for the first time in nearly a decade. Today's Federal Reserve decision is the last major financial event of the year, and it's only fair to say that all eyes are on the Fed. A brief background before we go any further. Former Fed Chair Ben Bernanke had hiked interest rates in June 2006 to about 5.25%. A year later, the credit crunch struck, followed by a global recession, which compelled the Fed to leave the U.S. interest rates at just 0 to 0.25%. If rates are hiked today, then Fed Chair Janet Yellen will probably take a dovish tone when she addresses the media at a press conference. A CNBC survey, meanwhile, showed that many are expecting at least three rate hikes in 2016. CNBC's Steve Leisman is here with those details of the CNBC Fed survey. Over to you, Steve.
If the Fed announces a hike today, it will have been, folks, 6 years, 6 months since the end of the recession, 7 years since they hit zero in December that year, 9 years, 6 months since the last rate hike, 11 years, 6 months since the last tightening cycle. I believe I had kids who were 6 and 4, one now going to college since that first time 11 years ago. Now, what to expect from Fed Chair Janet Yellen and the Federal Open Market Committee. Today, they have a major challenge explaining their actions to the street on the one hand and to the public on the other. The street wants to know about the policy outlook, so here's some of the things to look for. Does gradual path make the statement? In other words, how they describe future rate hikes. Some debate about whether or not they lock themselves in with language like that. Expect some positive economic commentary in order to justify these hikes. Look in the summary of economic projections for the Fed to lower their own forecasts about where rates are going to go. Does Yellen signal some form of a pause at the press conference? And then does she explain future policy goals so that the street itself can factor in where rates are going? We're moving from an era of what was pretty clear monetary policy goals. It was to increase inflation and reduce the unemployment rate. But how does Yellen today communicate those new goals from raising rates? Is it to keep inflation from rising, stop unemployment from falling, or is it simply to take out insurance on a potentially overheated economy and potential inflation in the future? It's a major challenge communications-wise. She has to explain the path to markets and the reason for higher rates to the public.
Thanks, Steve. And for more on that now, I'm joined by Mark Vitner, Managing Director and Senior Economist at Wells Fargo. Thank you, Mark, for taking our time to be with us. Let me ask you straight up, what are your expectations from the Fed later today? There is clearly a strong sense now that a 25 basis point increase is clearly on the card. Is it that obvious, Mark?
It's fairly obvious. It is hard to imagine the Fed not raising rates today because it's so ingrained in the markets. We've had this volatility the last few weeks. In many ways, they've already paid the price for raising interest rates. Any negative fallout from raising interest rates is already priced into the markets. And if they didn't move, it would introduce even more uncertainty into the financial markets, something that they don't need to do, particularly with oil prices falling like they are.
Right. Because many Fed watchers believe, Mark, that the central bank will hike interest rates in December, as you mentioned, then hit the pause button in Jan, and then react to the situation that arises out of that decision. Do you expect that it will settle the stage for another increase as early as March 2016, as many people in the U.S. seem to believe?
Well, I think they'll lay it out pretty clearly in the summary of economic projections that the dot plot that they release with their at their press release, and I think that in that you'll see that the future path for interest rates is even more gradual than it's been at previous Fed meetings. I don't know whether they'll pause in January. I suspect they will. But the Fed always goes into each meeting with an open mind, and they're going to react according to what the data shows. And one of the things that's kind of interesting here in the U.S. is that in the last few years, economic activity has slowed abruptly in the first quarter, primarily because the weather has been so bad. This year with El Nino, we've got much milder weather. And it's quite possible that we don't see that slowdown in the first quarter, and so maybe they don't have to hit the pause button.
Right, right. In fact, that's a fair point, because some would even worry that a rate hike at this point in time would, of course, sort of jack up the mortgage obligations and prices, and that could impact the housing sector, which is clearly one of the key pillars of the economy. How do you see that? Is that a legitimate concern?
I think it is a little bit a legitimate concern in that, and you look at what's happened in the housing market in the U.S., most of the improvement that we've seen has come in the apartment market. The market for sale housing, single-family homes and condominiums, has improved, but only modestly. And some of one of the big hurdles there is affordability. Income growth just hasn't been strong enough for enough people to qualify for a mortgage. And now that mortgage rates are going to rise a little bit, I think that's likely to slow housing more significantly than I think a lot of folks are expecting. We sponsor a survey with the National Association of Home Builders that's reported each month, and the data for December showed a larger decline than expected. It's still at a relatively healthy level, but it's fallen in each of the last 2 months. Permits for new single-family construction are running below starts, suggesting that we could see some slowing in housing activity at the start of the year.
Right, then is there a possibility then perhaps, because the CNBC survey says that it's expecting 3 rate hikes followed by the one tomorrow in 2016. Then what you're essentially saying that because the housing sector is still somewhat weak, at least it's not as strong as it used to be pre the global financial crisis, a rate hike tomorrow or in fact later today could perhaps force Janet Yellen to sort of push the pause button in 2016?
It's certainly possible, and I think that the really important time for that is not the January meeting; it's actually in the spring, because there's not a lot of housing activity that takes place in the winter months, and the spring is the most important time for the housing market. And if it looks like mortgage rates are rising too rapidly, that may cause them to back off. It's not the only thing they look at. They look at a variety of economic indicators. I think the indicators that have given them the most comfort in regards to raising interest rates are the employment data, which has shown a pretty substantial increase in the number of jobs created over the last few months, and also a significant improvement in the quality of jobs that are being created. More of the jobs that are being created today are full-time positions. Many of them are in higher-paying occupations, and that's given them a great deal of confidence to go ahead and raise interest rates, even though they're seeing some distressing signs in other parts of the economy. One of the things that's given them the most concern has been the increase in rates on high-yield debt, particularly related to energy companies.
Right, absolutely. And unemployment data really sort of strengthens the case of some sort of a U.S. recovery, which may prompt Janet Yellen to go ahead and make that 25 basis rate increase. In fact, we're just speculating right now, but that's according to a survey. But one final question, Mark, before we wrap this up. Also, another area where there could be some impact is in terms of how the dollar will react, because we've seen a stronger dollar over the last about a week or so, and many fear that a stronger dollar could further weaken the competitiveness of the manufacturing and the oil-producing sector. Anything you'd like to add on that in terms of the strength of the dollar vis-a-vis a rate hike, a possible rate hike?
Well, we do think that the dollar will strengthen against most currencies because the Federal Reserve is going to be tightening monetary policy in 2016, and unless there are signs that suddenly become clear that they're not going to move as quickly as the consensus has, a raise today and three increases next year, then I think the dollar will strengthen. If something comes up that suggests they're going to move even slower than that, then maybe we see the dollar back off. But with the strengthening in the dollar, I would expect to see commodity prices weaken further, and I think it's going to make put manufacturing in the U.S. and to a certain extent around the world in a pretty tough spot because we're just awash in excess capacity. Demand is growing very, very slowly, and I think that's a tough spot to be in. Normally, when the Federal Reserve is raising interest rates, the manufacturing sector is growing and is picking up momentum. It's the first time in my memory that the Federal Reserve will be beginning to raise interest rates at a time where the U.S. manufacturing sector actually appears to be in recession.
Wow, those were strong words, Mark. We got to leave it at that, but we'd love to have you back once we know what Janet Yellen will finally do. Thank you so very much for taking time out and joining us here on CNBC TV 18. We need to take a quick commercial break. Up next,